Well, hello and welcome to Global Mantra, the show that profiles prominent fund managers from the City of London and gets their views on the current global market environment. Joining me on this show today is Mark Artherton, who's the head of emerging markets at Aviva Investors, an asset management company that manages over $300 billion or so in global assets. About $20 billion plus is managed in Asia Pacific, and of course Mark himself overlooks about $5 billion as far as EM equities are concerned. Mark, it's great to have you on the show. Thanks very much for taking out the time.
It's great to be here. Thank you.
Okay, let's start off by discussing about 2011. I mean, it's being touted as the year for developed markets. That's a given. We've already seen the outperformance in the first quarter. Where does that leave emerging markets and the opportunity there? The sell-off and the withdrawal that we've seen, does that bring about an opportunity for you to accumulate at these levels, or perhaps just churn your portfolio, sell, buy, something like that?
Well, I think we've been looking very closely at the reasons behind this underperformance of emerging markets. It's pretty clear reasoning. You had a bottoming out of the ISM numbers in the US, an increase in demand there. And at the same time, marrying off against that, you had an increase in inflation worries in emerging markets. So the equity markets have just been fairly natural in choosing one over the other. Now, where the opportunity comes in is if this is just a relatively temporary phase and switch in investors' minds, and we think that actually is the case, and that's providing us an opportunity for the second half especially to find companies that have been oversold in this sell-off, and to reorient our portfolios to benefit from what we see in the second half, which is a decrease in these inflationary pressures.
So are you buying into emerging markets at this point?
I think in terms of aggregate allocations, that's still not the case. I think with what's going on in the Middle East, especially now, that the timing of that issue is slightly difficult. So our portfolios, we have been reducing within emerging markets the exposure to the Western consumer, and we have been picking up one or two names, but this is a very slow process, and those only really started in the past 3 or so weeks. What we're seeing is a sort of a more normalized environment where asset allocators can say, okay, we just want to take a little bit out of emerging markets and put it into developed because that's where we see the relative opportunity set. It's not we're panicking about emerging markets here because we think they're going to sell off. Well, I mean, it's 12 billion so far this year.
Yeah, that's exactly where my question comes from.
You know, I think those kind of things are more the top-down asset allocators. Okay. So you've got, you have a lot of flows into emerging markets last year came through the ETF, which is just a beta story. I mean, there's no stock picking in the ETF. It's just gaining aggregate exposure to emerging markets. Those flows that are reversed have come mainly from the ETF flows. So it's that kind of asset allocation, that more short-term beta-oriented asset allocation. The core institutional long-term allocation has been fairly stable and has grown throughout last year, and the outflows haven't been from that core. And we continue to think that those inflows will continue. Now, that's going to be always around that. You're going to have this volatility around ETF-style flows, which are much more short-term beta-style flows.
Okay. But the long-only funds, you think, would still stay invested?
Yeah, I think the fundamental investors are remaining fairly well invested in this area. And in fact, if you look at the numbers, remain significantly underweight where they actually should be in the emerging market region. And so we think that trend through time is still a long-term strong trend.
So perhaps from a 2-year perspective, you know, how much do you think would be allocated to emerging markets in the global asset pie?
I mean, I would think, again, not wanting to put too many numbers on this, but basically we would think there would be a positive bias, especially in the second half of this year. And in general, institutional investors are building their exposure to emerging markets. So we would think more than the current share that they have are likely to come in, especially in 2012.
About 20%? That'd be fair?
I would say, I mean, if you work on allocations being around about the 10 to 12% level, then maybe you could look at 15% to 18% coming into emerging markets.
Okay. The concern on crude, you've spoken about it. You know, as we sit today and talk about the issue, how can that mar return expectations for this year?
I mean, it's added increased complications, though equity markets are always complicated. I think one of the key things we have to look at is what are the realistic impacts of this rise in crude, and what's the possibility of a super spike in the crude price, which a number of analysts are now calling for. Our view is the increase in oil is a tax on the Western consumer, very definitely, especially at this point in time, and not really a huge inflationary issue for the West. Within emerging markets, headline inflation, yes, it has a definite impact, and it may increase the time before you get that roll-off of inflationary pressures within emerging markets, especially with the link through from oil prices to food prices. The final point on the spike is, yes, I mean, we're unsure today where these rolling revolutions are going to end. Where we are currently, the world has enough spare capacity in oil to be able to cope with this, albeit of different grades of oil, so not the same grades as Libyan crude, for example, but the world can readjust. It takes a little time, but it will readjust. And that's why we haven't seen a dramatic escalation in oil prices up into the $140 range yet. Now, were these revolutions and issues to pass on to some of the more larger oil producers, then that's very definitely clearly where you get a spike. And so equity markets have been very cautious about this because they're uncertain. Equity markets don't like uncertainty, and so therefore it puts a cap on where equity markets go.
But how do you as a fund manager insulate your portfolio from this kind of risk aversion or attitude that can come by because of this crisis or because of this worry, this risk?
Well, I think we're quite well positioned within emerging markets in that we have access to a large majority of energy companies that have good earnings exposure to the oil price itself. And I think more so than you see in Western oil companies. And so our fund in particular has been increasing its positions in Russian oil companies, for example, in Brazilian oil companies and across the board. And so within the portfolios, that's a way for us to protect against that kind of spike. And on the flip side, to fund those, then we've been reducing a little bit the emerging market consumer plays within that.
Well, when we come back in a bit, we will talk about the global EM allocation, where things stand, and which are the markets that Mark prefers in the region.
Now, what we've done with the increase in the oil price is reduce somewhat our exposure to the US consumer. We still believe it's a little bit too early to get back related to the emerging consumer. So we've been increasing our oil weight positions. Very clearly, as you get a growth in the middle class, you get a growing requirement for healthcare and for more than just your basic healthcare. They want Western standards of healthcare. And so trying to invest in those kind of areas is a way to access the middle class.